The agenda for tonight. So we'll start off with just, the basic definition of what a new build is, how to find and finance a new build, how to analyze the financial viability of a new build, and then finally, and probably most importantly, is utilizing the tax benefit known as the Section 13(6) Act, and why that's such an attractive thing for investors to look at. So let's dive right in. What is a new build? I'm not going to spend too much time on this. I think most of us know, but a new build is a new construction. So on the right, you're seeing plans. Sometimes you can buy a new build off plan, which means that it hasn't been built yet, but you're buying off the plans that have been created for that property. Or on the left, you're seeing the property or the new build has been built and then you're buying into it. But essentially a new build, it's a newly constructed property. Now, most for those of you who do know me, you'll know that I'm not a big fan of new builds. In fact, one of the videos that I recently published on YouTube is why new builds are bad investments. And I would definitely recommend that you go and watch this video. It's only 5.5 minutes, but I explain that new builds are not a good investment when you're looking from a cash flow perspective. And I still maintain that stance. Let me explain what I mean. From a cash flow perspective, a new build is a bad investment. Okay. Now, cash flow, you've either got a cash flow positive situation, which is on the left, or you've got a cash flow negative situation, which is on the right. Cash flow positive means your rent, the income that your asset is generating, is greater than your monthly expenses, including your bond, rates and taxes, everything. You're left with some profit, known as cash flow positive. Areas like Hillbrow, Berea, Rosettenville, your lower income markets, your inner cities, that's where your rent is justifiably higher than your monthly expenses, that you tend to walk away with a positive cash flow. Tends to be a bit risky in those areas, but that's where the cash flow works. Cash flow negative is where your rent less than your expenses means you have to fund. There's a shortfall and you have to supplement the property's losses with your own income. Okay, that is where the new build strategy doesn't make sense. It's a negative cash flowing strategy. Let me show you an example quickly. So this is one of the new builds that I was looking at in the northern suburbs of Cape Town. It's called Portofino. So here immediately you can see that the rental income is 90,000 per annum. That's about 7.5 per month. And the purchase price is 1.1 million. So I'll just open up my calculator and I'm going to do a very simple calculation known as the gross yield. So you take your annual rent divided by the asking price times 100, and that'll give you a gross yield of 7.9%. Now, what I like to work with is at least a 15 or 20% gross yield. That's where I know that the rental is going to more than exceed the expenses. So again, in like the Rosettenville multi-let market where I specialize, I'll only look at deals with a 20% plus gross yield. Anything under 15% is likely going to be cash flow negative. Okay. So 8%, that's pretty low. Now, the inside of these new builds are really pretty, but from the cash flow numbers, it's not going to make sense. So let me take you through the cash flow statement of this kind of investment. So I just went on to Property 24. I put in the purchase price of the 1.129 million, assuming I wanted to buy this property, using a 9% interest rate over a 20-year loan term. You can see here on the top right that the bond repayments will be 10,157. Now, we already know that the rent is 7.5. Now, whether you're good at maths or not, you're going to see that 7.5 coming in and 10.15 going out means you're going to be left with a negative cash flow. You're going to have to supplement this property. So on a month-to-month basis, right, you're getting 7.5 in, then you are obviously exiting some money. Right, you've got your bond, which is a major payment. You've got levies, rates and taxes, provisions, things like maintenance and voids and vacancies. Now, with a new build, you're probably not going to have that much maintenance cost for the first 3 to 5 years. Your vacancy will probably also be relatively low because a lot of people like to stay in new builds because it's all new and fancy and clean. But you're still going to have some management and some maintenance costs going forward. Here, with this specific investment. Hey, sorry, this light is a bit crazy. Your cash flow here is sitting at minus 4,957, meaning on a month-to-month basis, you're reducing your salary by $5,000 because you have to supplement this property. So from that perspective, guys, new builds are a terrible investment. You're not buying new builds because you want to generate a passive income stream and you want to be able to live off that income stream. Because no, the first 7 years is probably going to need you to fund it to be able to sustain itself. Yes, after 10, 15, 20 years, once you've paid it off, maybe. But if you're looking for that cash flow investment where you're getting that passive profit, new builds is not where you want to be. Okay. That is, in summary, why I created that video to say, look, new builds suck. But then there's a second element that one can look at, right? You've got your rental, but you've also got what we call capital appreciation, right? Now, over time, properties tend to increase in value. Now, when you're looking at your low income market, the likes of your inner cities and your low income, the rate at which the property appreciates is very low, if any, right? So when you're looking at the low income market, you want to make sure that this cash flow figure here is attractive enough, because you're not going to be making your money in 10, 20 years time, because the property is not going to appreciate that much. Versus your new build, there's a likelihood that the capital will appreciate at a greater rate than in your low income markets. Right? I tend to use figures of around 0 to 5% for a capital appreciation rate year on year in your low income market, and then depending on the new build, between 3 and 10%. But that's very much dependent on the area and what's going on in that area. The cash flow doesn't work, but there is a potential of capital appreciation. Now, before I go into this, please note, no one's got a crystal ball. No one knows what the future holds. As much as a developer or an estate agent might say to you, there's a guaranteed 10%, 15%, 20% capital appreciation, no one can know that for sure. The first investment that I ever bought was cash flow negative, and I bought it solely on the fact that the estate agent said this property is going to grow and basically doubled in value over 10 years. I recently sold it about 10 years later, and guys, it depreciated at maybe 2% per year. So, that probably was just a sales tactic. But anyway. So that is what a new build is. Let's now look at how you can find and finance a new build. Now, finding a new build is pretty easy. You can either go on to various property sites like Property 24 or Private Property and search specifically under their developments tab. So that's where you can find it under Property 24, or you can go directly to developers. So I personally like a company called iGrow. They're like a marketing house for a bunch of new build developers. So they work with the developers and then they present it. Can you put it a bit down? So I like iGrow. I think iGrow is a really effective marketing agency. But yeah, you can either go on Property 24 or you can go and find a developer and work directly with them. In terms of financing a new build, your best bet is probably going to be bank finance. Bank finance is going to be the cheapest form of financing, and banks really like new builds. I struggle to get bank financing when I'm in the inner cities and in the south of Johannesburg and the likes of Rosettenville, because the banks don't really like those higher risk areas. Absa is probably the most willing bank to venture into those markets. But when you're looking at new builds, the banks see them as very low risk, and getting 90 to 100% loan to value is pretty reasonable. So the trick with bank finance is that they are very strict with their criteria. So if you meet their criteria, it's easy to get money from the bank. If you don't meet their criteria, it's almost impossible to get money from the bank. And the two key things they're going to ask you for is, one, your credit score. I use a tool called clearscore.com. It's free. You just log in there. It pulls all your historical behaviors of how you pay your credit card, your bonds, your insurances, everything like that. And it gives you a score out of 705. You obviously want that to be high. The higher that is, the lower your risk to the bank, because the higher the number shows the bank that you are able to manage credit. So the higher the number, the lower the risk, the better the interest rate that they will offer you. The second thing they're going to look at is a thing called affordability, which is broken into two areas. They're going to look at your income, i.e. your salary. How much money is coming in every month and what can you afford to pay back? That's where the affordability comes from. But then they're also going to look at your net worth. So do you have other properties in your personal name or in the company or in the trust that you're investing with, because those assets will be seen as collateral, which the bank can then use to justify a bigger loan facility. All right. So the income, I think everybody gets that. You need to have a salary. It needs to be stable. You need to be able to provide, depending on the bank, certain proof of income, right? So here, if you're a salaried employee, you need to provide 3 months salary slips, 3 months bank statements, a copy of your ID, and then they'll send you a bunch of information sheets about your expenditure, that kind of stuff. So when you're looking to apply for a loan with a new build, these are the questions that they're probably going to ask you. If you're not necessarily salaried, but you're self-employed or you have your own business, it does get a little bit more tricky. So here you can see that they're looking for at least 2 years of tax returns and 2 years of financials. So now if you're a person that's just started just newly registered a company, you don't have that trading history. You don't have 2 years worth of financials to show them, which basically means that your company's here, you're going to have to provide personal surety to your company. So they're going to look at you and say, okay, cool. Well, what's your salary? What's your income? Because your company's got no credibility. And if your company defaults, we're going to come after you anyway. So yeah, I mean, it is possible to get a loan if you're self-employed or through a company. I'm doing it currently now. I'm getting 5 loans through my company, but I have trading history and I've got enough financials to satisfy the bank. But if you're starting out, it can be quite tricky. It's actually easier to get a loan if you're just a salaried employee as opposed to an entrepreneur or self-employed. So that's the proof of income. The proof of net worth. This is where assets, liabilities comes into play. So let me show you an example of what I like to call the middle class income statement or the middle class net worth statement. So usually your middle class has a steady income stream, one salary, working in the corporate world, right? That income then goes towards buying or paying off liabilities, things like credit cards or whatever other liability may be applicable. Whatever's left over gets then invested into expenses, and then hopefully there's some cash flow at the end of the month, which could be invested in an asset or maybe just spent on other things. So now that's for me or for the banks. This is someone that doesn't have, other than their salary, anything else that can justify a bigger loan facility. They've got an income. That money is spent on things, their insurances, their medical aid, their credit card debt, their groceries, everything like that. At the end of the month, they've got a couple of grand left over. So I will loan you money based on the size of that, surplus that you have at the end of the month. Now, when you look at someone who's got a wealthy statement, now this specific person is able to get a much larger loan facility because they have a bigger balance sheet. So with a wealthy person or a wealthy statement, you've got multiple streams of income. So you might have your job, but you've also got an online business and you do a multi-level marketing thing as well. And you've got 2 or 3 properties that are also bringing in additional income. So you've got multiple ways in which you're getting money. That income is then used to pay and buy more assets. Now, remember what Robert Kiyosaki, author of Rich Dad, Poor Dad, says, is he says an asset is something that puts money into your pocket. A liability is when something takes money out of your pocket. So an asset in this term is a cash flow positive asset where the rent is higher than the expenses. Okay, so that's the first thing. The income goes towards buying assets. The assets then pay the liabilities. Now, that's a very, very important thing. When I buy a block of flats in Rosettenville, the intention is for the tenants to pay the bond, the tenants to pay the rates and taxes, the tenants to pay for the insurance, the water and electricity, the management, the maintenance costs, right? If you structured it in the right way, you've bought it at the right price, your assets will pay for your liabilities, and then anything that's left over, you pay with your expenses, and eventually you reinvest into more assets. Now, when you've got this kind of balance sheet or this kind of thinking, and you're slowly but surely building up your assets portfolio, what you're doing is you're showing the bank that I have a lot of value and worth, that I'm a low risk person. Right? Because the bank is always asking the question, what's the risk of giving this person money? Right? They've got a salary, they can afford to pay me back, so the risk is now low. Their credit score is high. They're able to manage debt. They've shown repeated behavior that they can. Risk is low. They've got 5, 6, 7 paid off properties in their company, which means they've got a lot of collateral. Their risk is low. Does that make sense? So you want to be showcasing to the bank that you are a low risk individual to loan to, because then you're going to get a higher loan to value as well as a lower interest rate. Cool. So bank finance is where you want to go if you're looking at new builds. Easy to raise if you meet the criteria. If you've got a steady income stream and you've got a good credit score and maybe you've got some assets, bank finance is where you're going to be able to finance all your new builds without any hassle. Okay, let's quickly take another break and see if 1 or 2 questions have popped up. Okay, I see a question. Okay, Darren. General thoughts around the Baldwin brand. Baldwin. Now, I don't know them super well, but I know that they do those white developments. Maybe let me actually quickly have a look here, because I have seen a couple of them, couple of their developments pop up. And for those of you who haven't seen them before, this is their stock standard stuff. It sort of looks like this white with a blue roof, and that's their logo. To be honest, I don't know a good developer from a bad developer. I would say that these guys are doing really well. I mean, they're building in the south of Joburg. They've got a massive footprint in the north of Joburg. I've seen them put up some stuff in the Western Cape as well. So I think they've obviously got a relatively good name within the banks, because they're getting loans and financing to be able to build all these new builds. So yeah, I don't really have too much of a preference on them. I think they are probably a pretty good developer. Definitely a big business, So yeah, cool. No other questions. Michael, will the video upload be a full video on YouTube? So Michael, we are going to upload this video to the Property Bootcamp. So you can go and check it out there. We'll probably have it uploaded next week sometime. So yeah, cool. I don't see any other questions. Let's see here. Edgar, I've purchased a few properties from Baldwin and they cash flow if you do Airbnb on them, which they allow, and they have good facilities, restaurants and gym. So good point there, Edgar. I do think that you can get some cash flow positiveness going into your portfolio if you do the Airbnb strategy with new builds. But traditionally, you don't buy new builds because of the cash flow. If you want the cash flow, rather go to a different area, because you're not going to find it there. Here we go. What's your take on iGrow Wealth Investments? They generally have new developments that have shortfall for like the first 2 years. Yeah. Okay. So that's a good question. I am going to show you a couple of deals that I got from iGrow team, and we'll have a look at the shortfall. The reality is that iGrow, whether it's iGrow or Baldwin or any developer, the likelihood is that it's going to be cash flow negative. That's just the reality of when you're looking at it. Bully, thanks. Thank you, Lawrence, for such insightful presentation so far. For me, it's not even about capital appreciation of the new builds, because it's not guaranteed. Good point. I mean, it's a nice bonus. It's an added feature, but it's not something that should guide your decision. But the attraction for me is the promise of the Section 13(6) Act. Cool. Well, I don't see any other questions. You guys are being very quiet tonight. Hopefully it's because you're so engrossed by the presentation and I'm answering all your questions as we go along. I hope that's the case. Let's look at analyzing the deal, and then we'll end off with that tax benefit and see what that's all about. So when you're analyzing the deal, you need to be aware of what the shortfall is. So here, let's look at an example. This one is called Blue Rise. I think it's in Cape Town, or it could be in Joburg. I can't actually remember, but it's from iGrow. So iGrow is a like I said, a marketing agency that markets for new builds. And they sent me this, and they're like, Lawrence, this is a great deal. You must check it out, blah, blah, blah. So this is the proposal that they sent me. The first few things that I want you to note is that they are running this on a 0% deposit, which means that they're expecting 100% loan to value from the bank. That's great for me, because I don't want to be putting too much of my own capital into this investment. I want my money to be going into the cash flow deals, right? So if I can get 100% lending and I have to put almost no money down, because this value here of 700,000, that's inclusive of transfer fees and bond registration costs. So if I get 100% loan at 700,000, that means I have to put no money in, nada, that's really nice. The likelihood of that happening, I don't know. I haven't received word from the banks yet. We have sent the OTPs and I have applied, but I haven't heard back yet. The finance term is 30 years. The only reason they use 30 years is because they want to try and show that it's going to be cash flow neutral or slightly positive. And then they use an interest rate of 7%, which is fine. Guys, that's what prime lending is today. But I can tell you now that once the economy recovers, that's going to shoot up to 9.5%. So when analyzing a deal, I would never trust what a developer gives me, because they're going to try and show you a very pretty picture. So I would rather use 20-year term at a 10% deposit at a 9.5 interest rate, and then I'd see a more accurate or more realistic picture. The other thing to look at are the assumptions. So 8% capital growth, they showed me about 30 deals, and all of them have the expected capital growth of 8%. So they don't do any research. They just use 8% as a standard. That's what I've come across with iGrow. I mean, I might be wrong. If they want to, tell me otherwise, they're welcome to give me a call. But from what I've seen, all of them use a flat rate of 8% for capital growth and 7% for rental escalation. I don't think that's the case. I've looked at the specific area, and I found, a rental escalation of about 4.5%, and that was using TPN, which is a credit bureau, and it's a very reliable source. And then they've got a rental management fee of 11.5%. That's high, guys. I mean, in Rosettenville, I pay like 8%, including that. So they charge a high fee. And that's part of doing business with iGrow. If we look at their projection of what this deal will do, so here you can see a 10-year projection. You can see the cash flow monthly, so rental income of 5,800, and then it increases by 7% year on year, right? So they've just put that 7% on top of it. And then you've got your payments. So you've got your bond. Your bond will stay the same, okay, assuming that the interest rate doesn't go up, which it will. Then rental management, levies. There are no levies, which is quite exciting. This is not a sectional title, but it's more freeholds. So that's why there's no levies, rates and taxes. And then rental insurance. Now, rental insurance is something that I would highly recommend, because with the rental insurance, which is about 3.5% of your rent, they will cover eviction costs. They will deal with the eviction themselves. If you have a tenant that absconds or doesn't pay you for a couple of months, they'll cover that rental. You'll obviously have to read the terms and conditions to see exactly what is applied. But for me, if I'm paying a bit of money every month to rental insurance, but I know that evictions are guaranteed or the cost of evicting is being done, that's going to help me sleep at night. And then right here at the bottom, you'll see monthly surplus and shortfall. Now, this, of the 30 proposals that I saw from iGrow, this was the only one that had a positive cash flow number. Not great returns. Like, if I'm buying, I can buy a flat in Berea for 200,000 and make $6,000 rent, and my cash flow is going to be $1.5 grand, $2,000. If you're looking for cash flow, guys, this is not the strategy. This is not where you're going to be making the money from. Okay, but it's quite nice that this one should be able to fund itself from day one. And then the next thing to look at here is the equity. Now, this is where that 8% capital appreciation is, in my mind, quite misleading. I think we saw in the Western Cape that nationwide it's 4.5% was the inflation rate. And to think that it's going to be substantially higher than that at 8%, I don't think that's realistic. So this number here, where they're saying your equity, the value of your property is growing, I think you need to look at that with quite a lot of skepticism and say, I don't think that's going to be a true reflection. I would rather personally work on like a 4 or 5% capital appreciation rate and have a conservative view. And if the appreciation is 8 to 10% and I'm making some good money at the end, I wear. Obviously, that's nice, but don't delude yourself into thinking that it's going to be this great capital appreciation property, because, like I said, capital appreciation can't be seen. It can't be forecasted. There's no crystal ball. Second example, this one is, I think it's in Boksburg, Sydney Court, another development from iGrow. So same thing here. They've got their assumptions, which in my mind are a little bit unrealistic. What they've also put here is rental assist, which is a very nice function. So what they'll do is they'll assist you with rental income for the first couple of years, but you have to take on their rental management. Okay, I found that out recently. You can't just get the rental assist and not use them as a managing agent. So that's what iGrow, they're quite interesting, and I do like that about them, that they not only market and sell the property, but they also do the management. They also help you with the home loan. So what they're trying to establish is this one-stop shop for an investor who just wants to be lazy and just wants to, have everything being done by somebody else. So I like that about iGrow, as myself included. I'm not somebody who wants to spend too much time on these new builds, because my strategy is focused on that multi-let market. So yeah, I think it's an interesting value proposition. There's also a levy included on this one, so it's obviously a sectional title, and then there's the 3.5% for rental insurance. So let's have a look here. Same sort of thing, but here you can see the shortfall. So what's it, 6-7 years? I would say from the 30 plus new builds that I've looked at recently, 5 to 7 years is pretty much the average time it's going to take before this property can fund itself. So you should be projecting a 5 to 7 year shortfall period, after which your property will then break even and then slowly start to accumulate a little bit of cash flow. Again, be wary of that equity line. I do hope that when you buy into a new build that you get that 8% capital appreciation, but don't bargain on it. Don't put your numbers on it. So yeah, here you just need to know you're going to be funding this property for a couple of years. I would always suggest doing your own assessment. I've rerun all these numbers. I've pulled TPN and Lightstone reports of all the areas. I've gone and driven past the areas where I could. I've phoned agents. I've done research on pocket let. I don't trust anything that any of these agents say. So like this rent of this Blue Rise, I did go and confirm that 5.8 was a realistic income for that. I also looked at COJ bills, not COJ, City of Cape Town bills, so their utility bills, to see if 190 was a realistic figure. Always double check and vet everything. Because at the end of the day, you're putting your money on the line. The iGrow sales consultant is getting a commission from selling to you. So they've got no real incentive to put accurate numbers there. Their incentive is to get you to make a decision. And, if they can put a number there that makes it look a little bit more exciting, that helps you make that decision, some sketchy salespeople might do that. Okay, so that's how, I would say, see what the developer gives you in terms of the financial forecast, run the numbers yourself, maybe be a little bit more conservative in your estimates, and then you can pull the trigger. Also, go look at my YouTube channel. I've got a playlist called Deal Analysis. I show you how to do gross yield, return on investment. I analyze a whole bunch of new builds with you. So, if you're a little bit unsure as to how you would do that, there's tons and tons of content out there. But that is analyzing the deal. The final part of this presentation is the tax benefit, and I think the reason why most of you are on the call. But let me take a quick second here to answer a few more questions. Okay, Fulu, is that your new book that I saw in the beginning of the meeting? I joined the meeting a few minutes late. If so, can I purchase the book? Not yet, Fulu, but thank you for showing interest. I will definitely let you know as soon as possible. But it should be middle of August is when it should be in the bookstores. Otherwise, it will be on my website, www.lawrencebull.com. Okay, Edgar. As the cash flow is negative and the capital appreciation not certain, what criteria would you use to purchase a new build? Great question, Edgar. Both of those are very good points. The cash flow is negative, the capital appreciation is unsure. If I was just looking at those two things, I would never recommend that anybody buys a new build. But there is the Section 13(6) Act, and that is for me the reason why I've decided to invest in new builds. So I'm not going to answer the question now. I'm going to carry on with the slides, and I'll explain why. Byron, I've looked at a few properties. Difficult to get the bond and rates and taxes to even out on a 20-year bond, but 30 years is better to allow a break even. What are your thoughts on a 30-year bond? Personally, if you need to take 30 years to pay off the property, it's, you know, or to get it to be break even because your bond is slightly less, I would say it's not a good deal. You know, I've got, if you look again at like the Hillbrow, Berea area, and I'm not saying that it's not risky there, guys. Obviously, it's risky, but I mean, there you can work on a 15-year bond and still be cash flow positive with a decent return. You know, I wouldn't, if I can't get a deal to work on 20 years, I don't think it's a good deal. That being said, with a new build, if I can reduce the shortfall by a couple of $100 because I'm taking a 30-year payment term instead of 20 years, I'll go with 30 years because I'm going to anyway get a tenant to pay it off over 30 years, right? So I hope that answers your question. Do you think it's advisable to fix interest rate if you go below prime? So yeah, so some banks do allow you to fix an interest rate, which basically means that if you get your bond at, let's say, 7%, you know, you can fix it and you can say, you know, I'm going to take the risk. If the repo rate goes up, I win. If the repo rate goes down, I lose. I think right now to fix your interest rate is a good idea because interest rates are low, but you are taking that risk that if the interest rates do go lower, maybe there's another economic crisis or COVID wave 50 comes through, and you know, then you do potentially lose. What are the exit strategies to consider if you bought into a new build and then the value drops? Well, then you're screwed. I'm sorry to say. I mean, your exit is hold it and continue to lose and continue to fund it until eventually it's hopefully cash flow break even, or sell it at a loss and take the school fees out of that and take the learnings out of that. Unfortunately, there are very little exits. You could Airbnb it, I guess. If you're in the right area, you could rent it out for slightly higher using that Airbnb model. You could maybe try to multi-let it. If it's a big enough development, you know, maybe put 2 individual people in there and get a slightly higher rent. Sure. Other than that, I mean, I can't really think of too many exits. Unfortunately, I think that's one of the drawbacks. Okay, cool, awesome. I think those are the questions so far. Let's get into the juicy stuff. Okay, so let's talk about this tax benefits. Sorry. Okay, so the Section 13(6) Act. Basically, what that says is that you can write off a percentage of the cost of the buildings. Okay, that's what this act states. 13(6), write off a percentage of the cost of the buildings, but you have to own at least 5 new builds. They must be new and unused. Okay, that's the criteria. So you have to buy either off plan or you buy into a new build and you're the first person to place a tenant and you need 5. If you have 4, this doesn't apply. Okay. Now, when you have these 5 new builds, what you can do is you can write off 55% of the total acquisition price. That's huge. I mean, that's the equivalent of buying a property at half the price. Okay. So I spoke to iGrow. I asked them for a whole bunch of properties. We went through this massive long process of them giving me different ones to look at. These were the 6 that I identified of interest to myself. So here is one in Cape Town, Boksburg, Cape Town, Randburg, Cape Town, and Menlo Park in Pretoria. So these are the 6 properties that I found for my own personal requirements is what I like. These are the costs of each one of these properties. Okay. Now, once I've got 5 or more of these new builds, SARS says you can now recover 55% of the total cost of the base cost in tax rebates. What does that mean? That means that let's look at this first property, Blue Rise. If I buy it for just under 700,000, I'm going to be able to claim back from SARS 382,250 Rand. That's 55% of the value of what I bought it for. Right, so that's the total allowance. This can then be distributed to you annually or monthly. Okay, so this means annually for the next 20 years, I can recover 128,000 Rand from taxes in my business. So the reason why I'm doing this now personally is because I've got this portfolio of cash flowing properties. I've got a couple of blocks and a bit of student accommodation, and I've got these buy-to-lets, and this portfolio is making a nice profit. Now, what I want to do is I want to buy 5 new builds in this portfolio, because this portfolio can easily cover the shortfall of each of these new builds. Plus, I get to reduce the taxable amount of this business by 128,147. So now we're looking at it with 3 lenses. Okay, cash flow doesn't make sense, but my portfolio is able to fund it. The capital appreciation, we don't know if that's going to happen. We hope that it does, and if it doesn't, then it doesn't. The third thing is I get to claim back 55% of the value of this portfolio back in terms of tax rebates. Guys, I mean, that's amazing. That's really, really exciting. But that's not the full picture. There's another tax called the capital gains tax. A capital gain arises when you dispose of or sell an asset for more than what you bought it for. So you buy a property for X, you sell it for X plus 5. That means it has gained by 5. And you're going to have to pay tax on the difference between what you bought it for and what you're selling it for, because SARS says you've made a gain in capital. I want my piece of the pie. There are only 2 things that are certain in life: death and taxes. Unfortunately, guys, we have to pay our taxes. Okay, so let's look at an example. Let's say that in 2005, you bought a nice home for 1 million Rand. 15 years later, the value of that property is now 2 million, right? SARS is going to say that you have gained wealth of 1 million. So from the base cost of 1 million, when you bought it for 1 million, your base cost, it's now worth 2 million. That means you've gained 1 million Rand in wealth. We want a piece of that. Okay, now this is what I took a screenshot of SARS website. Please go and consult SARS and go look at their website, because they do change the rates every now and again. But as it currently stands, your capital gains tax rate for an individual is 18%, companies 22%, and other trusts 36%. Okay, so 18% of 1 million, 180,000 Rand. That's substantial. Okay, now this is where the trick with this new build strategy comes in. Let's say in 2021, you buy 5 new builds worth a value of 3 million, just for argument's sake. Okay, 20 years later, each property has appreciated nicely, and now the total value of this property portfolio is 5 million. Okay, if you look at that, you and I look at that, we see that the capital gain that we've experienced has been 3 million to 5 million. Okay, so we've grown in value or in wealth of 2 million Rand. That makes sense, but from the base costs. Now, when SARS gives you that deduction of 55% off, what they're basically saying is that you're buying the property not for 3 million, you're buying it for 45% of 3 million. So your base cost is not 3 million. Your base cost is after you've gotten that deduction from SARS. That's your base cost. So what that means at a 55% discount is that you didn't buy this portfolio for 3 million. You bought it for 1.35 million. So that's what SARS is going to say is your base cost. That's the value of your portfolio in 2021. Now the value of your portfolio is in 2041 is 5 million. That means your gain has been 3.65 million. So what does this mean? It's a very clever structure by SARS, right? They basically give you the ability to buy a property for half the price, and you get those tax rebates over the next couple of years. But when you look at selling the property is when SARS gets its money back. So SARS still wins. So basically what we're doing here is we're delaying the tax bill. You're either going to pay the higher purchase price now, and you won't pay capital gains as much, or you get that rebate back, your base cost decreases, but then your capital appreciation or your capital gains figure will be a lot higher. So I've thought about this, and if you want to still make this work, the reality is that you're probably going to have to hold the new builds indefinitely. If you never sell the new build, you never pay the capital gains tax. So you still get the benefit of the 13.6 Act, but as soon as you sell, you lose that benefit. Does that make sense, right? Whatever benefit you get from that 13.6 Act is completely relinquished once you sell, because the capital gains tax is where they will recover all of those losses from. So my personal strategy and what I've decided is to say I'm going to commit for that forever holding of a property. I plan to hold all of my low cost housing also forever for now. So hold the property, and then instead of selling, what you can do is you can release the equity. So your portfolio starts at 3 million and then it's worth 5 million, which means there's 2 million rand worth of gains in your property. So instead of selling, what you do is you just increase your loan facility on those 5 units. You take out more loan to cover those 2 million, and you pull that money out and then you reinvest it. So you can still play with that money. You can still work that capital gain that you've got. But just remember that if you do plan to sell, then you're going to lose that 13.6 benefit. And then, then it's not really worth it in the end. Let's go through the last few questions. I'm going to stop sharing my screen. How do I stop the share? Sorry. Okay, cool. Let's see the questions here. You mentioned banks don't finance your favorite places easily, but do you then manage to get finance in the likes of Berea? Sorry, this light. Okay, so it's a good question. Yeah, traditionally the banks don't love loaning on low-income housing. ABSA is a bit of is probably the leader in that market. Standard Bank is probably the worst. Standard Bank really likes like Craig Hall and Parkhurst and like the affluent areas in Joburg North. So when you're looking at areas like Berea, you do want to be targeting ABSA, Nedbank, but you also want to be targeting your boutique, smaller finance firms. So I've had a lot of success with a company called Sentinel Homes. I've also had some success with Combined Finance. Tough, TUHF, very, very good financial institution that will focus on your lower income market as well. So I think you've got to shop around. You can't go to your traditional banks as easily. With the new builds, you can go to any bank. Every bank will love it. When you're looking at your higher risk areas, sometimes you'll have to be a little bit more creative with who you approach. The other option is to do private finance. That's something that I've started doing over the last year or two. I get a couple of high net worth individuals or a couple of people with a few $100,000 in the bank that want their money to work harder for them. We pool our capital together and we go buy a property together. Private finance is probably where you're going to get the best luck in your higher risk areas. Okay. Is it best to register your first property under your own name or a company? It's a good question. So I tend to recommend going straight into a company. The reason that your personal name is not necessarily a good idea is because your tax rate is going to change as you become a bigger salary earner. So maybe when you're starting out and you've got a small income, your tax rate is going to be at the lowest income bracket. So you're only going to be paying 18% tax. But as you start to get promoted and earn more and more and more, eventually you start to go into the higher income brackets where you're looking at like a 45% rate. Then it just doesn't make sense anymore. Where companies are charged at a flat rate. 27% of your profit is what SARS wants. So in terms of tax efficiencies, you can be a bit more tax efficient within a company because you don't have to take the money out. You just trade within the company. You retain the profits. You pay the 27%. It's sweet. And when you register a property, you got to remember that, let's say you buy it under your personal name, right? And then in 5 years' time, you want to put it into your company's name. You're going to have to sell the property into your company's name, which means you're going to have to pay transfer fees again. So personally, a company costs like, I think, $1,000 to set up, 1,000, and it takes a week or two. It's quick, it's easy. I would just say go straight into your company, to be honest. Please advise on registering property in your personal name versus a trust or a company. So I think I did answer it there, but I might just add that a trust is a nice vehicle to include in your portfolio once you've got wealth to protect. So my recommendation with the students that I work with is get a company, buy a couple of properties in that company, and then sell the shares of the company into a trust. Now, some people might say that you first need to get a trust and then start buying properties. I personally think you first buy properties, you build some wealth, and then you put an asset or a vehicle in place to protect it. It's up to you. So what I've done in my personal capacity is I've built up a company that's got now sizable wealth. Now I'm putting a trust to own the assets, to own the shares of that company. I do have to pay some what are they called? I guess transfer costs, because I'm selling the shares of this company into the trust, so I do have to pay some transfer costs. But I think it's justified because a trust can be quite expensive. A trust is going to cost you $1,000 per month to manage. So if you don't have any wealth to protect and you just bought this trust now, the trust is just going to be eating your cash flow. But I would just recommend speak to an attorney, speak to an accountant, speak to a trust advisor or trust specialist. I'm not a specialist, guys. I'm just a dude who likes investing and likes sharing his knowledge. So yeah, let's see here. Sanjay, don't you think investors forget to look at the price they pay per square meter for these new builds? Some of these costs are very high. Yeah, I mean, I think the reality is that the developer's making money here. The developer is the one who's winning, not you. If you want to be winning in the property game, go to the low income market and get a property that is cash flow positive, because then your tenants are paying off your bond. So I agree with you. I think investors do forget to look at your rent per square meter or your price per square meter. If you're looking at like Santon, Bryanston, Sea Point, you're probably looking at 12 to 15,000 rand per square meter, which is sizable. So yeah, good point there, Sanjay. Do you claim the tax amount annually or over time? To be honest, Fulu, I don't know. I haven't bought the new builds yet, so I can't say for sure. But I assume it'll happen annually. That's what I'll chat to my accountant about. Because all that's going to happen is at the end of the year, based on the profit I make in my company, I'm going to have X amount of tax to pay. And I'm going to tell my accountant, okay, well, let's just deduct the benefit that I get from the Section 13 Sex Act and let me see what's left over. So I assume that it would be an annual thing, but I don't have the experience yet to tell you. Darren, is the tax rebate of Section 13 applicable to individuals or businesses acquiring property? It's a good question. Look, I'm buying those 5 units in my trust, which owns the shares in my company. So I'm not doing it. So it's not Lawrence buying these properties. It's my business, and I'm getting that benefit. So I don't think it really differs whether you're working with an individual or a business. But Darren, I would probably just recommend that you speak to an accountant about that, just to make sure. Michael, clarity regarding the 13.6. Do you buy 5 properties once, or are you given a number of years to acquire it all? So only once you've bought the 5th property does the tax rebate apply. So if you take, 2 days to buy 4 properties and then another 6 years to buy the 5th one, you're only going to get that tax rebate after 6 years, unfortunately. Byron, if I buy the 5 flats from the Blue Rise property at the same time, do I still get the benefits? Yeah, sure. It doesn't matter if you buy 5 in one new build or 5 across a whole bunch of different new builds. The only reason I've chosen different areas is because I wanted to diversify. All of my wealth is pretty much sitting in Johannesburg in the low income market. So that's why I chose a little bit more of the Cape Town feel and one in Pretoria, because I just wanted to, if all your eggs are in one basket, that can sometimes be risky. But yeah, 5 flats as long as they are new and unused. Pamela, hi, I have a plot. I need to build flats to rent there, but I need info. Okay, sure, Pamela. So that's more, you wanting to become a developer yourself. I haven't done anything like that before, but maybe there's somebody on the call. If there is someone that's on this call that has done a development before and they want to share their knowledge with Pamela, you can put a message on the group. I don't mind you guys networking with each other. Fulu, please go back to the previous slides with cost. I want to take a screenshot. I don't know what slide you're talking about, but Fulu, maybe just send me an email or go onto my website and request a call, and we can chat, and I can share the slides with you. Really. Hi, Lawrence. I have 2 properties under my company. I'm currently busy with another deal signing the personal surety. My question is, how long do I have to wait to buy another deal with a bank if there's a waiting period? I don't think there's a waiting period, to be honest. I mean, I might not know if there is a waiting period. It's more about affordability. So depending on how much salary or how big a salary you have and what kind of facility you can access, I don't think there will be a waiting period. The thing is, banks sometimes don't take the rental income into account. So banks like Netbank is pretty stingy. They'll look at the property that you're buying and they'll only take maybe 50% of the rent that property is going to bring in to add to your affordability. Some of the newer banks or maybe more innovative banks like your FNBs and APSAs, they'll take between 70 to sometimes 90% of that rental income and add it to your affordability. So I don't think there's a waiting period. It's always going to be about what you can afford and what you can't afford. That's going to be the question. How much is your coaching session? Love your book. Can't wait for the new one. Thanks for that, dude. I appreciate it. My coaching, I've got 3 packages. You can go check it out on my personal website, but it ranges between sort of 10 grand and 30 grand. So it's roughly 3,000 rand per session. So yeah, I mean, go have a look. You can also book a one-on-one with me on my website where I can take you through some more of the detail. Cool. Masejo, what is the 100 rand per month for? And also clarification, 2,500 per year. So yeah, I assume you're talking about the memberships. Yeah, so just go and have a look. I've got all the detail on the websites where it does tell you exactly what you get per membership. But basically what's included in the membership is a whole lot of advanced training and videos, the stuff that I don't post on YouTube. Plus you get access to templates. So like, sourcing agreements, shareholders agreements, loan agreements, OTPs, all of these different templates that you use or that I use on a regular basis with deals, you get access to those as well. Okay, last question so far. Apart from tax benefit, some people might argue that purchasing a rental property is better than purchasing land. Is purchasing land a good way to go if I want to get into something like student accommodation? The thing is, I haven't done any development before. It's definitely something that I aspire to, and I hope that in the next 5 to 10 years, I'm creating my own Bullwin brand, or I'm doing my own kind of developments. I think as a starting investor, purchasing land is a bit risky. The banks don't particularly like loaning to new developers. The only way you're going to get a good rate from a bank is if you partner with someone who's done a development before, because that's going to be the key question the bank's going to ask. They're going to say, you've got this great piece of land and you want to put up 10 units for student accommodation. What experience do you have in building? Okay, and if you don't have any experience, they're either going to expect you to partner with someone or they're probably not going to give you a loan. So I would say if you're starting out, rather buy a property that's already been built, build up your cash flow, buy a couple of units, get your cash flow up so that you've got some passive income so that you can leave your job and go full-time into this, and then look at development a little bit later on. Another strategy you could look at, which I think works quite nicely, is buying land, changing the zoning of that land, and then selling that land for a higher value. So, if you're looking for student accommodation, why don't you buy a big plot of land and get commercial rights on that land, and then go to a developer and sell that land to a developer for a much higher rate than what you bought it for, because changing that zoning creates and forces the value of that land to go up substantially. Cool. That looks like it's all the questions. I don't know if there was another question. Okay, cool. Yeah. Elam. Thank you for allowing us to network. I'm a conveyancer and a notary based in Johannesburg. If anyone needs assistance and maybe a discount on transfer fees, please email me. Awesome. Cool. Thanks for that. Let's see. Edgar just said, yes, 13.6 applicable to individual and company. Benefit is even more if in personal name, as you get physical refund from SARS when you submit your return. But there is a higher risk in purchasing in your individual name. Awesome. Cool. Thanks for that, Edgar. I don't see any other questions. I might have missed a question. If that's the case, please repost it. Otherwise, guys, thanks again for joining a great session and for enjoying this Thursday evening with me. Sorry about last week, but I'm glad that a lot of you guys came through and were able to watch this with us. You can always log on to this portal Crowdcast and rewatch the replay. Otherwise, you can go onto the Property Bootcamp, join as a member, and then you will get access to this video. Yeah, guys, thanks again for joining. And until next time, happy investing and hope to see you soon. Cheers.